the interest rate risk management, where we are going to discuss how we can use derivatives for interest rate risk management. I think when I stopped last time, we basically discussed in detail what is market risk, the different components of market risk, and in particular, we started with the interest rate risk and what are the different measures to or different techniques to measure the interest rate risk. If you can recall, there are three key measures we looked at. One is the repricing gap. The second one is the maturity model. And the third one is duration model. So those were the three key techniques we discussed to use measure the interest rate risk. So then I think the second part of market risk, the foreign exchange risk, you have already covered with Mr. Nishant, I think. Okay. Okay. So then there are two basically remaining parts of market risk: equity price risk and the commodity risk. But commodity risk rather, not really useful because it's basically the hedging of commodities if a bank holds commodities, which we are not going to discuss in detail, but we will look at equity price risk and how value at risk model is used to measure equity price risk later. But today we will look at how we can use derivatives to manage interest rate risk. Are there any questions you need to clarify before I move into the new session from what I did last time? Anything you need to clarify before we further move on to the session? Any queries? Okay. So if you don't have any queries, let's move with the topic today. If you look at derivatives, have you heard about derivatives before? I think hopefully when you do with Nishant, you would have heard about certain types of derivatives. Are you aware of derivatives? Or if you can give an example, anyone? Anybody? So what are derivatives?
I think options are one kind of a derivative.
Yeah. So what do you mean by, yeah, you're right. Options are one type of derivatives, but what do you mean by derivatives and what is the importance of it when it comes to
No
the,
clear idea, sir.
yeah, you can proceed. Yeah. Somebody said options. Yeah, that's right. Options are one type of derivatives. There are many more derivatives which we will discuss during maybe today and next class. So if you look at the risk management in the recent, decades, derivatives have become very popular as a tool to mitigate different types of risk. So if you look at a derivative, derivatives are financial instruments whose value or the price depends on a underlying financial instrument. Always the price is related to another underlying financial instrument. For example, maybe a stock price. Okay. So if you talk about a forward contract in a particular stock, the forward contract price, the value depends on the price of the underlying stock. Okay. Similarly, if you look at a commodity, let's say famous, I think if you look at, if you have heard even in countries like Sri Lanka, some time back, I don't know whether it's operating right now, we were talking about paddy forward contracts, the forward contracts for the paddy. Okay. So if you look at paddy contract, so the forward price or the value depends on the price of paddy. Okay. So basically the derivatives are financial instrument used to mitigate a particular risk. Could be equity price risk, could be interest rate risk, could be foreign exchange risk, whatever you call, depends on the underlying instrument. It may be paddy, it may be a particular stock, it may be an interest rate related instrument, it may be foreign exchange. Okay. So basically, so in broad, I'm not going to discuss derivatives in detail, the theory, but in broad, derivatives are financial instrument whose price or the value depends on the price of underlying financial instrument. So if you look at the different types of derivatives, we can talk, I have already mentioned here for the interest rate risk management. Broadly, there are about 4 to 5 categories. Typically, the financial futures, then forward contracts, then if you look at then SOPs also there are different subcategories. Then options. Okay, so within those categories there may be other subcategories. Now, for example, if you look at forward rate agreement, it's like a subcategory of a SOP. Okay, or maybe a forward contract. So when a forward contract subdivided or SOP subdivided, it's like a forward rate agreement. If you look at the options, within options there may be different options like interest rate options. Within the option there may be interest rate options, or maybe within SOPs there may be interest rate SOPs, foreign exchange SOPs. Like so there are a lot of categories of financial derivatives. Depends on the environment, depends on the markets, the different the institutions. I mean, typically here, if you look at a bank, may use the right instrument, or maybe the instrument which is best suited for them to manage their whatever the risk. Okay, so if you look at interest rate risk, now we will look at broadly 5 categories: the forward contracts, the financial futures contracts, the forward rate agreements, interest rate SOPs, options on interest rates. Okay, so these are the broad categories probably which we will look at during the presentation today and probably maybe next week. So let's start with financial futures. Sorry, have you heard about financial futures? Anyone heard about financial future? What is a financial future? Okay, so if you look at the presentation slide, financial future is a commitment between a buyer and a seller on the quantity of a standardized financial asset or index. Okay, so financial future contract is a commitment between a buyer and seller. Always when you talk about derivatives, there is a buyer and seller. Like normal market, there's a buyer and seller. When you talk about a futures or whatever derivative contract, you talk about a buyer and seller. So then the difference is, now when we look at when we discuss the forward contracts, we will see the difference. The futures contracts are standardized contracts. Okay, standardized contracts. You see the wording, quantity of a standardized financial asset or index. The future contract may be on an asset like a stock, gold, or maybe index. Maybe what you call interest rate related instrument, stock index, whatever you want to hedge and available in the market. The second point is the organized exchanges where futures contracts are traded. So if you want to hedge using a futures contract, you have to go through a future market and a standardized exchange. Now, for example, if you look at, if you want to sell a share, listed share, how do you do it? If you want to sell a listed share, or if you want to buy a listed share, how do you do it?
Share market transaction.
Sorry?
We trade it at share market.
Yeah. So basically, you can't just buy, in your own, because you have to go through the stock exchange. You through a broker, give your price or whatever, price you want buy, then there will be order depending on the availability of the quantity and the price in the market. So the mechanism, trading mechanism between buyer and seller takes place through a organized exchange. If you look at equities, it's a stock exchange. If you look at certain debt instruments, again, stock exchange. Okay. So basically, but there may be other ways that, if you look at unlisted share, it may be beyond the exchange through the other operations. Okay. So if you look at futures markets, again, there are recognized futures exchange in the world. Unfortunately, we don't have a derivative market in Sri Lanka. Probably you may have one in future where the banks and financial institutions can use this instrument for their risk management purpose. Definitely, I think in time to come there will be derivative market, standardized derivative market. But this is a very famous exchanges in many countries where the different parties use these type of instrument for hedging purposes. So the second point, as I mentioned, so you have to go through organized exchange. So that is why these products are standardized. You can't identify a particular instrument exactly matching your requirement. You see, so if you want to hedge a particular position, so you may not be able to hedge the entire position because the contracts are such a way that those are standardized. We will look at them later. Then, so what is the, so it's the general futures markets are like that. So there is a commitment between a buyer and seller to buy or sell a particular quantity of a standardized financial asset or index through a standardized exchange. So you don't have any option to match your requirement exactly the way you want, okay? Because these are set standardized instruments. Then we will move on to the our topic now. Since we are talking about interest rate risk management, how we can use interest rate futures for our risk management. So what is an interest rate future? So interest rate future is a future contract where the underlying asset is an interest bearing security. So if you use a interest bearing security for your hedging purpose, okay, then we call is a interest rate future. So future contract based on a interest bearing asset, okay, then we call it's the interest rate future. So let's look at in a little bit detail to understand the fundamentals of these contracts. So who is a buyer? A buyer of a futures contract is said to be a long futures. Now, when you talk about the derivative markets, there are two people. I said it's a commitment between a buyer and seller. Okay, commitment between a buyer and seller. So whoever the buying party, we used to say long futures. Okay, so what are the obligations for the buyer? So the buyer agrees to pay the underlying futures price or take delivery of the underlying asset. So the buyer has to either pay the underlying futures price or take delivery of the underlying asset at the time of maturity. So then how the buyer benefit from the market when an interest rate related contract? or whatever contract, the buyers gain when the futures prices rise. Futures prices rise and lose when futures prices fall. So buyer gains when the future prices rise. Buyer means the person who are long. Okay. So let's say NDB Bank, for example, have a futures contract. They bought a futures contract. So the NDB Bank is a buyer, and seller is say HSBC Bank. Okay, so there's a futures contract between the NDB Bank and HSBC Bank. So NDB Bank is the buyer, HSBC Bank is the seller. So when the future price goes up, what happens? Who will benefit? NDB will benefit because the future price goes up. And if the future price goes down, NDB Bank will lose. Then somebody will ask the question, then what is the purpose of hedging? Okay. Now, when you talk about futures contracts or the forward contracts, the idea is not to make, profit, okay, or not to incur significant loss. So here the idea is to minimize loss. So if you don't have a futures contract, say that your loss would be, let's say, 100 million in case the what you call the interest rate or whatever react against you. Having a futures contract, try to minimize that risk. So rather than incurring a loss, you may end up significant loss. You may end up with a lesser loss. So that is the idea. Okay. So if you are a long futures contract, so you are the buyer, so you gain when the futures prices rise and you lose when the futures prices falls. Seller. Now, seller of a futures contract is to be short. So when we talk about the derivative market, whether it's a future or some other instrument, remember, we talk about always long and short. So this is a typical, terminology we use, long and short. So let's say when the NDB Bank is long in futures, what does it mean? NDB is a buyer. So if you say NDB Bank is short in futures, what does it mean? NDB is a seller of a futures contract. So remember that. Sometime you may not be told, you are buying or something. The institution is long on futures. So you know the meaning. Long means you are the buyer. The institution is short on futures. That means you are a seller. Okay. So the seller agrees to receive the underlying futures price or deliver it to the underlying asset. Okay. So sellers gain when futures prices fall and lose when futures prices rise. So it is the opposite of the buyer. So that buyer gain when the future price rise, lose future price falls, but seller is the opposite. The seller gain when the future prices fall and lose when the future prices rise. So it's the mirror image. Okay, so that means gain of a buyer is a loss for the seller. Gain for the seller is a loss for the buyer. Then we will look at few more instruments like cash or spot market. So I think all of you know as bankers what is cash market or spot market. Now, market for any asset where the buyer tenders payment and takes possession of the asset when the price is set. Okay, so at the time the price is set, the buyer take the possession by tendering the payment. So that's called the cash market. Now, generally, the cash market is immediately, but if you look at spot market, you talk about a 2-day delivery. So then forward contract or the futures market, forward market is where the buyer and seller agreed on the asset price today, but defer the actual exchange until a specified future date. So basically you agreed for the prices today, but delivery will take place at a future date, maybe 3 months time, maybe 6 months time, maybe 9 months time, depending on the agreement. So that is called a forward contract. Okay. So the futures contracts are a typically type of a forward contract. So, but the price agreed today. Now, for example, we forget about a bank. Let's say two gold, traders. Okay, one person selling gold. Okay, Mr. A, and this person selling gold, Mr. B, agrees to a contract today. So where they say party A agrees to buy 10 million worth of gold at a whatever price quantity, but not today, in 6 months time, from gold seller B. Okay, so basically the difference between a cash market, spot market is, from the forward market is, in a forward market we agree the price today. Today we say, okay, I will buy gold, whatever, pound, whatever, maybe 8,000 rupees today, or whatever price, but on this date only transaction will take place, 6 months time, but the price is agreed today. So that's typically a forward contract. So let's move on to the different. Now I said, if you look at forward and futures, both typically the same, but there are slight differences. Now, as I mentioned, the futures contracts are traded on a formal exchange, like, stock exchange. There are separate exchanges for futures contract. Now, if you look at the most commonly traded futures contract is in US, the Chicago Board of Trade and the Chicago Mercantile Exchange. So I already explained they involve a standardized instrument. So that means the instrument is specified. So these are the quantity, these are the maturities. So we can't find, contract exactly matching. Now let's say I want to hedge a position maturing in May or maybe August, but I can't hedge exactly the maturity I want because the contract may be maturing in the stock exchange June, maybe September. So if I want to hedge a position in May, the May or August, I may not find the exact instrument. So because they are standardized. So I have to find the instrument which mostly match my requirement. And the other point is positions require a daily mark into market. So where you have to keep a margin, like, when you open a stock exchange account, you have a stock account. So like such account, there will be account in favor of the registered party who are trading in the futures contract, maybe a bank. So then, depending on the price, now futures price, now if you look at stock market, the price of the stocks moves ups and down daily. So depending on the ups and down, your value also goes up and down. Okay, so if you have, let's say for example, if you have a stock market account, you have 1 million shares worth of John Keels. So when the John Keel price goes up, your value will go up. When the John Keel price goes down, your value will go down. So like here in futures contracts also, when you hold number of stocks, number of futures contracts, your value will move up and down depending on the futures price in the market. So daily, so you have to adjust your portfolio value, that is called mark into market, so that you need to keep some money in your account if there are adverse fluctuations. Okay, like in a margin account, the position required deposit equivalent to a performance bond. Okay, so always you have to start with a, before you start trading in the futures contract, you have to put up some money into your margin account at the futures exchange, which is we call the performance bond. Then let's look at the difference between forward and futures. Now, all this time we were talking about futures contract. Now, what is the forward contract? Again, forward contract, typically there is an agreement between the two parties. There is a buyer, there is a seller. Okay. So there's a party who is buying to agreeing to buy a particular asset at a particular price or index at a particular price in a future date. Hence, there's a seller. But the difference is, in a forward contract, that is not traded in the standardized exchange. Now, for example, two banks, want to hedge their positions. So rather than going through the futures exchange, they discuss internally among themselves of the market and come to agreement to hedge their position. So one bank may be a buyer, another bank may be a seller. And so the advantage is, now I said futures contract which are standardized. So you don't have any option to hedge the position you want in the exact way you want. But in a forward contract, now let's say you want to hedge a position of $1.6 million position of a particular instrument. Now, if you want to do with the futures, do you have futures contract with exactly matching your 1.6 million position? No. We will come to later, futures contracts are standardized $1 million. If you want to hedge $1.6 million position, you can't exactly match. So either you have to buy one contract or two contracts. So you can only hedge your position partially. But if you want to do it through a forward market, so you get together, and decide on the right price for you and as per your requirement. The require no cash exchange until expiration and no market to market. So there is, because this is not through exchange, there is no market to market. So this is understanding between the two parties. Now, typically, I can give a very general example, without looking at financial markets. Now, if you want to buy a shirt or trouser, you go to the whatever the shop or Dell or wherever you want to go, you buy a shirt. So does it exactly match your requirement? Let's say trouser. Does it exactly match your requirement? Anyone? You go to a Dell, you want to buy a shirt. So you look at the first, you buy something. So does it exactly match your requirement? Let's say trouser. Anyone, please?
Not as good as a tailor-made one.
Huh?
Not as good as a tailor-made one.
Exactly. So it may partially fit you, but not exactly. Maybe it may be a little bit, length is little bit too much for you. So you have to stitch it again. Okay. Your waist may not be a little bit, tight or loose. Okay. But if you go to a tailor, okay, you go to a shop nearby, your hometown and go to a tailor and he takes the measures exactly, then he will, prepare a shirt or trouser exactly matching your requirement. Okay. So that's the same, here in a futures contract. So if you look at futures contract, you can't find exact matching, but if it's a forward contract, it's a tailor-made. Okay, it's a tailor-made. It's not a standard. So exactly the tailor will make a shirt for each and every person exactly matching your requirement. Okay, so that is the key difference. But again, the problem is now in a futures contract, since it is traded in the standardized exchange, there is no default risk. There is no default risk. But in a forward contract, so it's an agreement between the two parties. Either party may default. Default means, they may, break the promise, later. Okay, so that is the risk when you go through a forward. So it has advantage of matching your requirement exactly the way you want, but there is a possible default risk. Okay. Okay. Margin requirement. Now, I mentioned earlier also, in a futures market, okay, always you want to have a account. If you want to trade in, futures contract for whatever purpose, maybe hedging, maybe speculating or whatever purpose, you have to have an initial margin account and you have to deposit certain amount as an initial margin. Okay. Then, when the value fluctuate every day, then you have to maintain the margin at a particular level. So there you have to deposit some money every day depending on the margin, the value. We call the maintenance margin, the minimum deposit required at the end of each day. So another feature is, unlike margin account for stocks, future margin deposits represent a guarantee that a trader will be able to make any mandatory payment obligations. Okay, so stock margin accounts are a little bit different, but here this is a guarantee the trader will be able to make any mandatory payment obligations. So the same effect as a performance bond. Then I mentioned again marking to market. So marking to market is a daily settlement process where at the end of every trading day, trader's margin account is credited with any gains. If your positions go up or you make a gain in the position you are holding, the gain is credited to your account. Similarly, if your futures value comes down and you lose, so your account will be debited, so that the margin account is maintained at the right level, so that there is no risk to the settlement. The variation margin is the daily change in the value of margin account due to marking to market. So whenever the daily margin account value changes daily, so that is called the variation margin. So the expiration date, every futures contract has a formal expiration date. Okay, so let's say the contract expires in 30th June, so that is the expiration date. Okay. On the expiration date, trading stops and participants settle their final position. So if you buy a futures contract expiring on 30th June, okay, then trading will be stopped at that date. So the parties, the buyer and seller, has to close their positions. Okay. The less than 1% of financial futures contracts experience physical delivery at expiration, because most traders of their futures position in advance. Now, usually, even though you buy or sell a futures contract, sometimes you may not hold it till maturity or the expiration. So you can trade it in between, depending on the market prices. Okay. So then there won't be any physical deliveries, and very rarely you will have a physical delivery at the time of expiration. Any questions so far? Anything? Any clarification before we move on to the next slide? No? Okay. So let's look at a typical example of futures contract. Now, if you look at, this is the internet, many banks, even in a domestic bank, can use euro-dollar time deposit futures for hedging purposes. So this is euro-dollar, 90-day euro-dollar time deposit futures are very common short-term interest rate related instrument used by many banks around the world. Okay. So typically, the euro-dollar time deposits are dollar-denominated deposits issued other than USA. Okay, so that is why euro-dollar. Euro-dollar means the dollar-denominated instrument issued in a country other than US. So that is called euro-dollar. Okay, so 90-day euro-dollar time deposit futures are very common. Okay, so any financial future based on these euro-dollar 90-day time deposits called 90-day euro-dollar time deposit futures, which is commonly available in the international markets, futures markets. Okay, so the underlying asset is a euro-dollar time deposit with 3-month maturity. 90 days means 3-month maturity. The euro-dollar rates are quoted on an interest-bearing basis. Assume a 360-day a year. Probably you would have heard there are different, when you did your foreign exchange, there are different day count conventions. So if you look at US, usually they follow 360-day convention. Then some other countries follow 364-day. Now, if you look at certain countries, they follow 365. Okay. So there are different day count conventions followed by different countries. So So here the interest rate quotes are based on a 360-day a year because every day counts. Okay, so based on a 360 days. So when they quote annual interest rate, it is assumed that's a 360-day interest rate. Okay. So each euro-dollar futures contract represents 1 million of initial face value. So if you want to buy euro-dollar contracts, euro-dollar futures contract, always one contract size is $1 million. Okay, $1 million face value, not the market price, face value. So that's why I said, a few minutes ago. So if you want to position, like 1.6 million, can you hedge exactly the way you want using the euro-dollar futures? Can you? Anyone?
No, because futures are standardized.
Yeah, no, so my question is, if we want to hedge 1.6 million, you have a position, interest rate risk position of $1.6 million, or maybe let's say $3.4 million position you want to hedge. So can you use euro-dollar futures contracts exactly to mitigate your risk?
No,
No, sir, you can't.
Why?
you can only hedge 3 million.
Yeah, so basically you can't find a contract matching 3.4 million because each contract is 1 million. So you can do two ways. You can either buy 3 contracts and hedge up to $3 million, forget about the balance, or you can go extra hedging of 4 million contracts. Sorry, 4 contracts worth 4 million. So that's either it's under hedge or over hedge. So because you can't hedge exactly, 3.4 million dollars. Okay. So again, the other thing is you can't exactly match your expiration date also. Okay. You can't match expiration date. So if you look at euro-dollar time deposits, 90-day time deposits, futures, 40 separate contracts are traded at any point in time as contracts expire in March, June, September, and December each year. Okay. So basically, the contracts expire in usually March, June, September, and December each year. So there are 40 such contracts. So different contracts of trading at any given point of time. So the buyers make a profit when the futures price or the rates fall. Sellers make a profit when futures rates rise or price falls. Okay. So buyer make a profit when the rates fall. Seller make a profit when the futures rates rise or the price falls. Okay. So depending on the position, you have to decide whether you want to be a buyer or you want to be a seller. Okay. So you have to identify your risk position to see whether you want to go long or you want to go short. Well, buyer means you are going long. Remember, I mentioned a few minutes ago. Seller means you are going short. So whether you want to hold a long position or short position, depending on the underlying risk in your financial interest rate related position. Now, contracts trading according to an index. So the contract price or the index, not the price, the index is called 100% minus futures interest rate. Okay. If the futures interest rate is 5%, or sorry, 5.5%, the index is trading at 94.5. Okay. 94.5. Okay. So, so depending on the interest rate, futures interest rate, your price will vary every day. So then you can buy, whatever the quantities of futures you want at the desired, the price which is trading in the market. Each basis point change in the futures rate equivalent to a $1.25 change in value of the contract. So remember, I said the contract value is $1 million. Okay, $1 million. The day count convention is 360. So 90 days futures means 90 over 360 into point. So 1 basis point change means what? 0.01% change. Okay, so of course, if you look at in the within bracket, there should be one zero again. 0.0001, 3 zeros. There should be 3 zeros into $1 million into 90 divided by 360. So whenever the future there is a change in 1 basis point. So 1 basis point means how much? 0.01 percentage. All of you know 1% means how much? 1% means how many basis points? Bankers, I mean, how many? 1% means how many basis points? Now, in your
100.
bank, your risk management guys or bank traders talk about there is a change in 15 basis point. Interest rates have moved up by 15 basis point. What do you mean by that? When your traders say in the bank, interest rates move up by 15 basis point. What do you mean by that? What do you mean by that?
0.1%.
0.15%
change.
Yeah. So 15 basis point mean 0.15% change. That means the interest rate gone up by 0.15%. So 1% means what then? How many basis point?
Hundred.
100. So 1% means when you talk about 1% interest rate change, it means there is a change of 100 basis point. Okay. So here each basis, so 1 basis point, that means 0.01% change will result in the futures contract price or futures price will change by $25. So that means if there is a 1% change, what would be the change in the futures price? If there is a 1% change, how much the futures price change? Either up or down? How much? Now let's say you hold 2 contracts of 1 million, futures contract. You hold 2 contracts worth 2 million futures, euro dollar time deposit futures. Okay. So let's say in DB Bank, you are in DB Bank, you hold 2 contracts worth $1 million, euro dollar time, 90-day euro dollar time deposits. Then you hear the news, the interest rate, the futures rates change by 1%. 1%. Then what is the impact on your bank? What is the impact on your bank? By how much your value will change? By how much? Pretty simple question. you hold two contracts. That means worth, one contract worth 1 million, two contracts, 2 million. Okay. 2 million. Then interest rate futures. So interest rate on futures on this 90-day euro time deposit moves by either way, up or down, by 1%. 1%. Then how much the value of your futures contract change?
20,000.
20,000. How did you get 20,000?
1% of 2 million.
No.
5,000?
Huh?
5,000?
How much?
5,000?
5,000. There's a small noise by somebody's mic. So the 5,000. So how did you get 5,000? Can you explain how did you get 5,000?
That is the 90 days now. So the entire year, that is 20,000. Then 20,000 is divided by 4.
Okay.
That is how.
5,000. Okay. So it's pretty simple. If you look at now here, I say one basis point change, that is 0.01%. 1 basis point change will result in $25 difference. Okay. For $1 million contract. Now, if 1 basis point results in 25, 1% means how much? How many basis points?
100 basis points. That comes 25.
Result for one contract is 25 into 100. 2,500. Okay. Then you have two contracts. 2,500 into 2. 5,000. Pretty simple. Okay. So 0.001 into $2 million. Okay. 0.0, not 0.01. 0.01 into $2 million into 90 divided by 360. Okay. So it's basically pretty simple. So you can anytime find out how much your value has changed within period as a result of change in futures rate. So you know whether your future value is gone up or gone down. Now here I have given, this data is a little bit older, but even if you go and look at today, you will get the results similar here, how these futures are quoted. So you can find out any futures contract you want to hedge. Now, if you look at today, you can find futures account trading up to 2022, maybe 22, end of 2021. So here, the first column is the settlement month and the year. You see April, March, April, June, September, December, March, June, September, December, 6, 7, and so on. So usually you see the typically contract settles on March, June, September, December. I think you have seen April also one particular year. Then you have the opening futures price. Then within the day fluctuation in a particular day. Then the settlement, the closing price. Okay. Then the yield. The yield is the difference between the 100 minus 96.99. Sorry, what do you call final price? Sorry, the settlement price, 100 minus settlement price is the yield. Then whatever the open interest or whatever. So this is typically you find anybody who want to trade in a futures exchange, you will find this data, so you know exactly what type of futures contract you need to purchase or you need to sell. So just for the information, you can have a look at the latest information. Then again, we will move for another important terminology, the basis. So basis is the cash price of an asset minus the corresponding futures price for the same asset at a given point in time. So it's the difference between cash price and the futures price for the same asset at a given point in time. For financial futures, the basis can be calculated at the futures rate minus spot rate. So if you look at futures rate and you know the cash rate today or the spot rate today, the difference between those two also called the basis for financial futures. So the basis may be positive or negative depending on the futures rates are above or below spot rates. Sometimes futures rates may be above the spot rate depending on the market sentiments, the market expectations, or below. Okay. So may swing widely in value far in advance of contract. Now let's say talking about 3 months futures contract. If you look at the price today, you know, and maybe tomorrow, and as you go on in the future, there will be wide fluctuation well in advance. So when you are much, you know, advanced to the expiration date, the fluctuation is very, you know, large. But when you close to the expiration date, the fluctuation will be minimum. So in other words, the futures price will reach the cash price when the future, you know, expiration date is much closer. Okay, so that is the meaning of, you know, the basis. Now, for example, I have inserted few slides to explain this. Now, if you look at the top part of it, I have given, this is extracted from the futures exchange in this particular, you know, future expiring in December 2005. So let's say you are a holder of this future. When you look at March 10, the cash price is cash rate is 3% and the future rate is 4.09. Then future rate is widely fluctuating above the cash rate until closer to the expiration date. So you see the future rates significantly go up and coming down close to the cash rate towards the latter or towards expiration. Okay. So if you look I think if you others can switch off the mic, it is better because there may be disturbances. Towards the latter part here means that towards the expiration date, the cash price future price, the future rate reaches close to the cash rate. Then the bottom part of the graph shows the basis. So you know basis is futures rate minus cash rate. So you at the beginning of the contract, you see futures rate is, you know, around 1.09. So then it goes the basis is 1.09. It goes as high as 1.76 towards August, and then gradually basis will come down and reach a 0, because at the expiration, what happens? The cash rate and futures rate should come together. So basis will be 0. Okay, because there is no benefit towards the expiration. You don't get any benefit by the contract. Okay, so that's how this basis fluctuate. So basis is the future rate minus cash rate. So you have to be mindful of that fact. What is the right time you should you know, use the contract. Any questions so far? Okay. So if you don't have any questions, let's move to the next part. Example of hedging. A bank anticipate needing to borrow $1 million in 60 days. The bank is concerned that interest rates will rise in the next 60 days. Okay. So if the interest rate rise, what happened? Then the borrowing cost will be higher. Okay. The bank anticipate needing to borrow $1 million in 60 days. The bank is concerned that rates will rise in the next 60 days. So the possible strategy would be to short euro-dollar futures. Okay. You short euro-dollar futures. So what happens if the interest rate rise? If the interest rate rise, short futures position will increase. Okay, the short futures position will increase. Because if the interest rate rise, price will drop. Okay, price will drop. So your short position will increase. Okay, so that you can gain a benefit out of your short position of futures, which can be offset against loss in the cash market. Because in the cash market, interest rate goes up, your borrowing cost will rise. But in the futures market, your futures position will go up, you will end up with a gain. So the loss in the cash market will offset the gain in the futures market. So basically you can manage your risk. Speculation versus hedging. With financial futures, risk often cannot be eliminated, only reduced. Okay. So when you talk about financial futures, as I mentioned, you can't completely eliminate the risk. You can partially reduce the risk. But you can't find a contract exactly matching your requirements the way you want. And also the basis change will not be equal. Why there is a basis risk? The cash market price or the cash rate and the, what you call futures rate may not fluctuate simultaneously. You saw in the previous graph. If both fluctuate simultaneously, you can fully hedge. To go to the graph, you see there is a difference between cash. Now, when the futures rate goes significantly up, but cash rate is not going that way. They are not parallel. So that's why there is a significant basis risk. So you can't fully hedge your position. It's a perfect hedge. The gains or losses from the futures position perfectly offset the losses or gains on the spot position. It's very difficult, but if you can find something, some hedge like that, then you can fully mitigate your risk. So your loss in the cash market can be fully set off against the gain in the futures market. So it's a little bit difficult. That's called the perfect hedge. Now, for example, given some graphs, how this hedge position works. Now, let's say you buy a futures contract today. The first graph, you buy a euro-dollar futures contract today at 95.91 at the futures rate of 4.09, okay, percent. So what happens? Let's say if your futures price rise. So futures price rise, what happened? So if the futures price rise above 95.91, you will gain. Okay. If futures price goes below 95.91, you will lose. Okay, you will lose. Then go to the graph below that graph, hedge position. What happens in the cash market? Okay. So when the futures, so how the futures price rise? Interest rate drops. So interest rate drops, futures price rise, isn't it? Interest rate increase, futures price drop. So in the cash market, when the interest rate rise, what happens? You lose. Okay, you lose. Okay, interest rate drops, you gain. Okay, so when you combine two, so your futures gain is offset by cash loss, or futures loss will be offset by cash gain. So your hedge position is, so this is called, I mean, here in this graph, this is a perfect hedge. Perfect hedge. Okay. So alternatively, let's talk about selling a future contract. Under what circumstances you will sell a future contract? Why do you want to sell a future contract? Under what circumstances? You are a banker. Now, under what circumstance you will sell a future contract? Now, here we are talking about interest rate futures. Under what circumstances? Why you want to? What is the risk? And to mitigate what sort of an interest rate risk you will sell a futures contract? Anyone? Under what sort of an interest rate risk scenario you will sell a futures contract? Here now we are talking about interest rate futures. Under what circumstances? Under what circumstances a bank would sell a futures contract? Anyone? I think it's a pretty simple question. Under what circumstances of interest rate movement you will sell a futures contract? At least someone, I mean, you are all bankers. You can't understand this basic principle, you know. So we are talking about interest rate risk management. Under what circumstances you should sell a futures contract? Under what circumstances?
Is that interest rate fall?
Interest rate fall, what happened? Is it right? Interest rate are the opposite, isn't it? Isn't it? Opposite. Okay. So look at these examples. A short hedge is appropriate for a participant who wants to reduce spot market risk associated with an increasing interest rate. Clear? Okay. So when you see a possible interest rate increase, what is the best strategy? Selling futures. Agree? Yeah. So if you expect interest rate to rise, because what happens if the interest rate rise in future, your borrowing cost would be higher. Let's say you are a bank, you want to borrow in future, the risk is the interest rate rising. So in the cash market, you lose if the interest rate rises. So interest rate rises, cash market you lose. But if you sell a futures contract today, you can gain by possible interest rate increase in the futures market. So if you look at the second the graph in your right hand side, so you short or sell futures contract, if the interest rate rise, what happen? You will make a profit, or the if the interest rate drops, you will incur a loss. Okay. So interest rate drop means price will rise. Interest rate increase means price will drop. Okay. In the cash market, look at the graph immediately below that. Cash market, when the interest rate rise, you lose in the cash market. But that will offset against the gain in the futures market. If the interest rate decline, your borrowing cost will be less. You will gain in the cash market. But in the futures market, you are losing. So the loss in the futures market offset the gain in the cash market. So your hedge position is the x-axis neutral. This is just an example of a perfect hedge, but this may not be perfect, but at least you minimize your risk. Clear? Okay. Any questions before we move? So probably when a scenario is given on the interest rate environment in the future, you should be able to identify the right hedging strategy. Okay. As a banker, let's say you want to borrow in maybe 6 months' time. So what is the risk you see for you? Now you want to borrow 10 million rupees in 6 months' time. So what is the risk you see? What is the risk to you? If you want to borrow $10 million in 6 months' time, not today, you are the banker. What is the risk to you? Pretty simple question I am asking.
Interest rate rise.
Interest rate rise. So, what is your strategy? What is your strategy? If so, what you can do? What you can do?
You can sell today.
What? Sell what? Sell what today? Sell today means what? What you are going to sell today? Let's say you want to borrow $10 million in September. Okay, $10 million in September. So what you can do? But you have a risk that you have a concern that depending based on the current market interest rate environment, the rates will rise. So what is the risk to you? Your borrowing cost would be higher. So what will you do? So these are options. I mean, if you are given some scenario, you should be able to analyze and tell exactly some, how you are going to hedge. So what you are going to do? If you understood what we discussed, I mean, you should be able to give the answer. Anyone? At least single? I don't know whether you all are in the lesson. At least one person should be able to tell this. I mean, these are practical things you may come to in your day-to-day risk management. You have you want to borrow some 10 million US dollars from a party in 6 months' time in September. But now you don't want it now today. You don't want it today. So you want to borrow in 6 months' time. Let's say September. Then your concern is, the interest rate, US dollar interest rates may go up in the future. Let's say that is your concern. Then in September, by September, let's say today's US dollar rate may be 1%, but you expect it will double to 2%. So what happens? Your interest cost will be double. If the rates goes up, we don't know. We don't know. We don't know. Today we think. So we think there's a possible risk of interest rate going up for US dollars. So what is the strategy you follow? What is the strategy you follow? What is the strategy you follow? Now, When I say borrow means, let's say you want to issue some deposits. You want to raise funds through euro-dollar deposits for some purpose. So how do you hedge your position? So if you want to raise, because you don't want those deposits now, you have adequate US dollar deposits now. But for whatever purpose, maybe there is a, there's a big maturity coming in, September. So you want to issue new euro-dollar deposits on that date from a banking perspective. I am referring to banking perspective. So, but the risk is, now today your euro-dollar deposits are, 6 months deposits are moving around 1%. But there's a possibility of interest rate rise for 6 months euro-dollar deposits to 2%. That's the expectation. By 6 months time, it may be not 2%, it may be higher, it may be lesser, it may be even lesser than 1%. We don't know. But there's a possible risk. So as a risk manager, what you should do? Pretty simple question. What you should do? Quickly, we want to move fast. At least someone, we just discuss. And pretty simple question. If you get something like this, the exam, you will never answer this. Pretty simple. I have given a scenario, I have asked you a question, how you are going to manage your risk. At least one fellow should come. I don't know. I rather doubt this is the problem in this online teaching. I can't, see you. I don't know whether you are in the lecture or what you are doing, but at least those who, previously, expressed their views, at least someone come to answer. Possible answer. Can anyone come with the answer? What happened? No one? No one? So what is the
So
risk?
we
Yeah.
need dollars, but the thing is at which rate?
Sorry?
We need to sell dollars.
Sell dollars. Why do you want to sell dollars?
If we have adequate stocking,
Yeah. But if you have dollars, why you borrow in 9 months time? If you have dollars, why you want to borrow? If you have dollars, do you want to borrow in 9 months time? Or maybe, whatever, in September? Now you want to borrow dollars in September. So if you have dollars, why do you want to sell dollars? You can keep dollars now. So there is no risk to you. Now risk is you don't have dollars now. You want to borrow. Huh?
hedge the rate now to buy dollars.
At the rate, buy dollars.
Now to buy
Yeah.
dollars in the future to a specific rate.
Yeah. So how do you do it? To buy the dollars, how do you do it? You want to buy in the forward market. You want to buy in the forward market, dollars. Is it a question of dollar buying here? No. No, the question is our interest rate. Okay. Question is our interest rate. You want to borrow. Okay. So it's not a question of foreign exchange rate now. We are not going to, hedge the foreign exchange position. So you misunderstood the question. The question is you want to borrow 10 million US dollars, want to borrow 10 million US dollars in 6 months time. So the risk here is you're borrowing into, if the interest rate rise, your borrowing cost will go up. Pretty simple. It's not exchange rate risk we are talking about. So what is the pretty simple way? You short September euro dollar futures. You sell. Pretty simple. It is in the graph. I mean, at least one person couldn't give that answer. It's in the second right-hand side graph is pretty simple answer to that. In the cash market, if the interest rate rise, you lose, you set off with futures market. So today you sell futures contracts, euro dollar futures contracts to hedge the risk. So pretty simple. Okay.
Sir, could you please again explain the 4 graphs?
Yeah, that's better, sir.
Okay, now the first graph is about a market interest rate falls. If the market interest rate fall, in a market interest rate falling scenario, let's say, for example, you want to invest in future on a particular instrument. So what is the risk? Now you have to look from the risk perspective, depending on what you do as a banker. So if the market interest rate is going to go down, come down, what happens? Your investment income will go down. So what you can do? So I'm giving just an example. Okay. So if the interest rate falls in the future, so your income will fall in the cash market. Okay. So if the interest rate falls, I'll go to the bottom one first and then explain. If the interest rate falls, what happened in the cash market? What happened? Price will go up. Price increase means what? Price increase means the price increase means interest rate fall. Okay. So in the cash market, you will lose. Then if the interest rate...
I didn't get it, sir. Sorry.
Oh, now if you look at now features, what happened, so that's why I have been repeatedly asking whether you understood. None of you told. Okay. Now look at the index. An index of 94.5. If the interest rate, the index price equal 100 minus futures rate. If the futures rate goes up, what happens? What would be the price?
Price go down.
Go down. Interest rate come down, price will future interest rate
Go up.
down, price will what happened?
Go up. It will go up.
So this is what I have been telling all this. I think some of you may be cooking, some of you may be doing, baby carrying. I think that's why I repeatedly ask, are there any questions? Please, if you don't understand, please ask questions. So if the interest rate goes up, price will come down. If the interest rate comes down, price will go up. Okay. Even if you look at here, that's what happens. So if the interest rate goes down, what happens? Price will again no answer.
Go up.
Go up. Okay. So what happened to the future price? If the interest rate goes down, what happened? Price will go up, isn't it? So the interest rate goes down means price will go up. Interest rate goes up means price will go down. Just the first graph is that. So when you buy futures today, euro-dollar futures today, if interest rate declines, so first graph is about interest rate declining. Okay, your price of the futures contract will go up. So that means buying some futures today, if your expectation is interest rate to go up. Now remember, we do this thing because of a risk scenario. Risk scenario is here interest rate goes down. So interest rate goes down mean our cash market, what happened? Our investment will, investment income will come down. So what we do is we hedge using a futures contract. So the futures price will be gain, cash price will be a loss. So there will be a hedge. If the opposite happens, interest rate goes up, futures price will be a drop. But if the interest rate goes up, what happened in the cash market? We will gain. Because our investment income go up. So then there will be a positive the profit in not the positive profit, there will be a profit in the scenario. So we will gain. So the futures market we lose, but cash market you gain. This is the opposite of interest rate price. So interest rate price, it's the opposite. You are going to sell the futures. You are going to sell the futures. It is the opposite of interest rate decline. So this is a very pretty simple explanation. Okay, clear? Okay. So, so what are the steps in hedging? Identify the cash market risk exposure to reduce. Now you have to identify what is the risk to you. What is the cash market risk? So that is the first thing. Without knowing that, you don't know what to do. Okay. Now you are a banker. You want to borrow something in 6 months' time. Okay. You want to borrow something in 6 months' time, or you want to issue a debenture. Issue a debenture in 6 months' time. Take a simple example. Or you want to raise some deposits in 6 months' time, new deposits, dollar deposits, or whatever deposits in 6 months' time. Then what is the risk to you? That is the first thing. So in the cash market, what is the risk to you? What is the risk to you?
Interest rates will go up.
Interest rate go up. A pretty simple thing. I mean, all of you should answer pretty fast. Risk to you is today interest rate are 10%. I want to issue these deposits or borrow in 6 months' time. Between today and 6 months' time, interest rate goes up. It's a risk to me. Because if I raise money today, I can borrow at 10%, but there is a possibility interest rate goes up to 11, 12%. Then I have to pay the mobilized same deposit. I have to pay additional interest rate. So that is the risk. So you have to identify the cash market risk. Given the cash market risk, determine whether you want to long or short. Okay, depending on the cash market risk, what do you want to do? You want to decide whether I'm going to long or short. Okay, now here, if the interest rates are going to rise, what I'm going to do? Are you going to long or short? What are you going to do? Again, taking too much time. I explained several times now. Now, these are not things you can't, you have to think, patas, you should come. What is the now? You have identified the risk. Now you are going to hedge it. So what is the futures? What sort of a future? It's a long or short. What do you want to do?
So it will be short.
It should be short. So you sell futures. Why you sell futures? Because you know interest rate is going to go up, price would drop. So you today sell some futures maturing in 6 months' time. And select the best futures contract. So select means, let's say you want to borrow in June, then identify maybe May, you want to borrow in May. So identify the best suitable contract close to May. Then determine the appropriate number of futures contract. Now, as I said, you can't exactly match, so identify the number of futures contract. Then you either buy or sell the futures contract. If it's interest rate going to rise, you sell the futures contract. Interest rate going to drop, you buy the futures contracts. Okay. Determine when to get out of the hedge position, either by reversing the trade, letting contracts expire, or making delivery. So you have three options. Once you do the futures, buy or sell the futures contract, you can in between, you can go out of the hedging position. Okay. So if you bought, you can sell in between by reversing the trade, or letting the contract to expire. So you can wait till the expiration date and contract automatically expire, or take the delivery of the contract, or make or take in delivery of the contract. Verify that futures trading meets regulatory requirements and the bank's internal risk policies. So pretty simple, and given any scenario, you should be able to identify the right hedging contract you need to you need to hedge. Okay, any questions so far? Anything? If you have any thing clarify, please ask questions.
But in the futures market now, it's a kind of an exchange market now. So can we just like find the exact requirement of ours in the futures market? And on the other side now, when we are going to, let's say in between, we can sell it now. So given in that case, will there be people who are going to accept the same contract price as, I mean, to...
Yeah, it's a market. It's market like that. No, in a stock exchange, if you want to sell 3 stocks, you can sell. Depending on the buyers, there are buyers. If you have, let's say you want to sell John Keel's 5 shares, can't you sell 5 shares? Can't you sell 15 shares? Can't you sell 1 million shares? If there are buyers, you can sell. Okay, so in a market, there are buyers, there are sellers. You may not be able to sell the price you want. So maybe if you want to sell 10 shares at 15 rupees, there may not be buy at 15 rupees, but there may be a price for that. Okay, so the market price, at the market price, you can sell. So there are buyers and sellers. Now the first question, I have been telling this several times. I don't know whether you joined later. I said you can't exactly, in a futures contract, you can't exactly match. So I have been repeatedly telling this from the beginning of the lecture. So that is the difference. Now futures, even earlier I told futures contract, if you want to hedge a 3.4 million worth of position, you can't hedge it exactly. See, so that's the nature of the futures contract. So you can't meet your requirement. So I again told like a trouser, tailor-made trouser and a Odell-made trouser. So you have to understand these things. So please join the lecture at the beginning so that everybody will understand. I have repeatedly mentioned these things, difference between futures contract and the forward contract. So futures contract, okay, you may not get the exact hedging you want because you can't, let's say, if you want, now here we are talking about euro-dollar futures for short-term interest rate risk. Now here I am talking about interest rate risk related futures contract. So there are other futures contracts. equity futures, so many futures, foreign exchange futures. But here we are talking about interest rate related futures only. I'm not going to discuss other futures here. So try to hedge as much as possible. Sometimes it is underhedge, sometimes it's overhedge. You have to decide. If you find you can't exactly match. But there are buyers and sellers. So you can, let's say now take example of a debenture trading in a market. So you don't need to wait till maturity. In between, if there are sellers, buyers, you can sell it. So that's why I said, determine when to get out of the hedge position, either by reversing the trade. Now, if you have a long position, how do you reverse it? If you are a long position, how do you reverse it? How do you reverse it if you are a long position? You are
So you
short.
have to sell, I think.
You have to short. If you have a long position, reverse it by shorting. Okay. If you have a short position, reverse it by longing. So you can exit. Okay. Or letting contracts to expire. So let the contract expire at the maturity. Automatically contract expires. Or making or taking delivery. The physical, physically, buy or sell part. Okay. So let's move on to the long hedge. Now, long hedge is appropriate for a participant who want to reduce spot market risk associated with declining interest rate. So if you expect in the spot market, the interest rates are going to decline, then better you buy futures or long hedge. If spot rates decline, futures rate will typically decline, so that the value of the futures position will like to increase. So if the value increases, what happens? You make a gain in the futures market. But if the interest rate decline, you lose in the cash market. So the loss in the cash market at least partially set off by a gain in the futures. So for example, your bank expect to receive 1 million rupees or dollars, whatever, in November, and anticipate investing the funds in a 3-month euro-dollar time deposit. Now, what is the risk to you? What is the risk to you? What is the risk to you?
Interest rate goes down.
Yeah, interest rate goes down. So you want to invest in 3 months dollar deposit, but in November. But if the interest rate goes down, your investment income will come down in the cash market. So what do? You can go long on futures contracts, 3 months euro-dollar contract. Okay. So you can buy futures contract, 3 months euro-dollar contract, maturing in what you call September. Sorry, here November. So that you will make a gain in the futures market. You will make a loss in the cash market. Your cash market loss will be what happened? Offset by futures gain in the futures contract. So you will offset the risk. Okay. Okay, so it's the graph for the example. So you go buy futures contract today, probably your investment will start in November. So you will find the expiration date close to your investment date, very much closer. It's available in December. So your futures contract will expire in December. So you will make a gain if interest rate interest rate fall in the futures market, and you lose in the cash market, so that you can sell the futures contract in November. So you can buy today and sell in November. Okay. Clear? So let's look at a short hedge. The short hedge or the sell futures is appropriate for a participant who wants to reduce spot market risk associated with an increase in interest rates. Increasing interest rates. So, for example, you want to borrow some funds in future, maybe 6 months time or 3 months time, but you anticipate the spot interest rate will go up during that time. So you will have to incur a higher borrowing cost. So what the best strategy would be to short futures, sell futures. Okay. If you sell futures, what happens? If the interest rate rise, the price will drop. So the futures market, you can sell at a higher price. So you will make a gain in the futures market, but lose in the cash market because higher borrowing cost. Then your loss in the cash market will be offset by gain in the futures market. Short hedge. So on March 10, 2025, your bank expects to sell a 6-month €1 million deposit on 15 August. So basically you want to mobilize some deposits in August. The cash market risk exposure is that interest rate may rise and the value of the euro-dollar deposit will fall by August 2005. So there the people will ask for a higher interest rate than what is prevailing now. So in order to hedge, the bank should sell futures contract. So even if the interest rate rise, so you have to offer a higher interest rate to the depositors, but since you short futures, you can gain in the futures market because futures price will drop by that time. Okay, because you can sell at a higher price. Clear? Okay, so this is the example. So today you sell futures and you buy futures contracts in August 17. Where at the time of you want to raise these deposits. So the closest contract you find is September 20 contract. So this is why I told you, you can't match exactly the date, August 17, 2015, sorry, 2005, because you don't have futures contract maturing in that day. So the closest contract is the September 20th contract. So you can, today you can sell a September 20 contract maturing in September, but on the August 17, you can buy the contract because you have already sold, then you can buy. So you reverse your position if you want. So you are partially hedging your position. Clear? Any questions before we further move? Okay, we'll explain this and stop for a break. On March, what happened? You buy, you sell €1 million deposits in 127 days. The cash rate is 3%. In August, this is related to the previous example. You sell €1 million deposits, okay, 4%, because now interest rate has gone up by 1%. So what is the loss to you? 1%. Because today the deposit rates for these deposits are 3%, but in August, it would rise to 4%. So basically, you have lost 1% interest rate. Loss means you have to pay higher interest rate. So that is 100 basis point. So your additional cost would be $2,500 per one contract, 1 million contract. Now, what did you do? Because you anticipated interest rate rise. Okay. So what did you do? You sold futures contract. Okay. You sold futures contract. So the futures rate today is 3.85. So trading at a price of 96.15. So let's say the futures price on August 17 is 4.14 futures rate. So what is the future profit? 4.14 minus 3.85. By selling futures contract, you got a gain of 0.29% basis gain, 29 basis points. So what is the total gain in the futures market? Is $25 into 29. That is 725. So if you didn't have futures contract, if you didn't sell futures contract, what would be the loss to you? What would be the loss to you? Without hedging, what would be the loss to you if this scenario happens? So you didn't have any hedging. Without hedging, what would be the loss to you in this scenario? Without doing anything, you just went ahead with this cash market transaction. So what would be the loss to you? Loss in the sense increased cost to you.
$2,500.
2,500 because interest rate went up by 1%. As a result, you have to pay for 1 million, one contract to raise 1 million US dollars. You have to pay additional interest cost of 2,500. So if you raise 10 million contracts, then you have to pay 10 of such 2,500, 25,000. But since you knew that interest rate is going to go up, you enter into a euro-dollar futures contract. So as a result of futures contract, now what is the loss? What is the loss? Now you hedge using some futures contract. Now what is the loss? What is the loss to you? Come on, guys. I mean, it's in the shade. Are you
It's minimized to 1,775.
Yeah, 1,775. I don't know whether you all are with me or you all are doing something else. It's clear, because of the hedge, you make a gain of 725. So the effective loss would be 1,775. You see? So that is the advantage. So that's what I said. Hedging will not completely eliminate the risk. Remember earlier I told it will reduce. You can't expect a perfect hedge. If you can do a perfect hedge, fine, but it's very difficult through a standardized market. So at least you brought down by now here the loss means what? What do you mean by loss here? Additional interest cost, isn't it? Because if you raise today, you would have raised at 3%, but in August, rates gone up to 4%, so you have to pay additional 1%. So as a result, the increase in cost for 1 million contract is 2,500. So if you have 100 million such contract, it multiplies by 100. Okay. So your loss was reduced by 725 for one contract. So your effective loss or the additional interest cost would be only 1775. So in other words, your effective interest rate is 4% minus 0.29%, 3.71. Even though cash market rate is gone to 4% by August, the actual amount you are going to pay is 3.71 because of your futures market short position in the futures market. So this is a very classic example of how you use a futures contract to hedge against a rising interest rates. Similarly, you can look at anything on the interest rate decline. If you are going to make an investment, how you can reduce the interest cost. Okay. Any questions before we stop there for a break? Any questions? Please clarify all those things. We don't do it again. So today or maybe next time only we will do this part. So then probably, you should be able to have a clear understanding, given any situation, how you are going to do it. No questions? Okay, fine. So we'll stop for about 30 minutes break and we'll start at 11, around 11 after the break. Okay, if you have any further questions, you can start once we start the session. Okay, so we'll stop for the break now. Okay, thank you. Shall we start?
Okay, sir.
Okay. So let's move on to the next slide. Just again, slight reference to the basis. All of you know the basis is difference between the cash price and the futures price, or the futures rate and the cash rate. Okay, so it could be either positive or negative depending on the cash rate and the futures rate. Change in the basis, long and short hedges work well if the futures rates move in line with the spot rates. So basically, I think you saw in the previous graph, the changes in futures rates and cash rates are quite different. So you see the future rate fluctuations are very significant compared to the cash rates. So when there's a significant difference, you can't, exactly hedge your position also. But if they are moving, parallelly, then of course you can reduce your risk to a greater extent. So the actual risk assumed by a trader in both hedges, whether it's a long or short, is that basis might change between the time the hedge is initiated and closed. So if I go back to the graph which I showed you earlier, you see at the time of beginning the contract, as per this graph, what is the basis? So what is the basis? About 1.09%, but you see it has gone up to 1.76 by August and gradually declined. So if the basis remain at a constant level without significant fluctuations, then definitely there is a better chance of minimizing the risk to a great extent. So in the long hedge position, we looked at the spot rate increased by 0.93% while the futures rate fall by 0.06%. So this caused the basis to fall by 1.99599. So that's in the previous example of the long hedge. Okay, so let's go to the micro hedging applications. When you talk about the different hedges, we can divide it into two, the micro hedge and the macro hedge. So what is a micro hedge? Now, as a banker, you can either do a micro hedging or macro hedging. Now, in a micro hedging, we are focusing on a specific asset or liability or a commitment. So hedging of a transaction associated with a specific asset, liability or commitment. But macro hedging, we are looking at the holistic picture of the entire portfolio of assets, taking futures position to reduce aggregate portfolio interest rate. Now, for example, now let's say you want to invest in a particular instrument in future, or you want to borrow through a particular instrument in future. So the risk, there is a possible risk associated, interest rate risk associated with that particular asset or liability. Now, let's say you want to invest in a deposit in 6 months' time. So what is the risk associated with that particular deposit in future? Now, you as a banker, you want to invest in a 6 months deposit in 3 months' time, some big amount. So what is the risk associated with that?
Interest rate going down.
Interest rate going down, exactly, interest rate going down. So you hedge that particular instrument only. So that is called a micro hedge. Now, another example, you want to sell. Now, you have a treasury bond, particular treasury bond, not the portfolio. Particular treasury bond matures in 2000, maybe 24, but you want to, what you called, sell it in 6 months' time. Sell it in 6 months' time. So what is the risk there? What is the risk between today and 6 months' time? So what is the risk? Anybody? You have a particular bond which matures in 2024, but you want to trade it or you want to sell it in 6 months' time. So what is the risk?
You might not get the expected return.
But return is fixed. In a bond, your return is fixed. Coupon is fixed. What is the return you lose? Expected return means what? You get the return because your coupon is fixed in a bond. Generally, if it is a fixed rate coupon. So what is the risk?
Price range.
What you said is not the coupon, I think. So what is the risk in terms of interest rate? So you want to sell. So what is the risk?
You might not be able to invest at the same rate. Again, reinvest.
Yeah, okay, okay, that's a different thing. But okay, before that, okay. So what is the risk? Tell me exactly what is the risk in this particular transaction related to interest rate. The risk is now if the current market interest rate is 10%, if the interest rates for this particular bond will go up to 15% in 6 months' time, my price will drop. So the rising interest rate, if the interest rate rise, my price will drop in 6 months' time. So at the time of selling at 6 months' time, if the interest rate rise from the current interest rate, I have to sell only at a lower price. So that is the risk. Okay. So my price will be lesser. Okay. So my price will be lesser. So what I can do is, so the rising interest rate, what I can do now as a micro hedging principle.
You can sell futures.
Exactly. So you can short futures today. So you can go to the futures market and find out, whatever the appropriate, treasury bond futures contract available in the market. Okay. So available in the market, matching a similar, features of the underlying asset of a particular bond. So you can find out a future bond in the market and sell futures today. So what happens when if the interest rate goes up in the cash market? What happens? You lose, because at that time cash price is lesser. But in the futures market, you have sold futures contract today. By the time of selling, your futures price has also come down. So but you sold futures at a higher price, you gain. So your future gain will be offset by cash market loss. So basically, so those are called micro hedge. Micro means particular instrument. So macro hedge is you are looking at a portfolio. Now as a banker, now micro hedging is little bit cumbersome in a as a banker, because you always have to think of each and individual transaction and each and individual asset or liability. But macro hedging is more holistic view. Rather than looking at individual asset, liability or commitments, you look at the entire balance sheet position. Remember, we discussed duration. Remember, we discussed entire balance sheet hedging. Remember, I think all of you can remember the very last lecture we looked at duration hedging. Okay, so how do you what do you by duration hedging? So we want to match duration of assets and duration of liabilities for the entire portfolio. Entire balance sheet. Remember, we did some questions. So our changes in equity equal minus duration gap into assets into change in interest rate divided by 1 plus R. Remember the formula? So that is called macro hedging, duration hedging. Now here we use derivatives for macro hedging. So basically what we do is we take futures to match the hedging of or manage the hedging, manage the interest rate risk of the entire portfolio. So that's called the macro hedging. So let's look at the micro hedging first. So the mechanics of applying a micro hedge: determine the bank's interest rate position, that is current position, forecast the dollar flows or value expected in cash market transactions. So like the previous example, now the particular bond which we are going to sell, so the current interest rates are 10%. Okay, if we sold at current market, this is how much we are going to realize from that bond. Let's say if I sell that bond today, I will get, let's say, 10,000 rupees. But I don't want to sell it today because I need money in 6 months' time. But if the interest rate goes from current interest rate to higher interest rate, I will gain only 9,000 rupees in 6 months' time. So that is my forecast, expected cash flow. Then what should I do? So I should choose the right futures contracts available in the market, which is best fitting for me, so that I can short futures contract, so that I will have a gain in the futures market to at least partially cover the loss of 1,000 rupees. Okay, I may not be able to fully hedge, but at least partially I can cover my position. So how do I determine in the futures market how many number of contracts I should buy or I should sell? So you can use this formula. The number of futures contracts equal A, A is the dollar value of the cash flow to be hedged. Now let's say today I have 100 million worth of those bonds, so that is the dollar value of my bonds cash flow. Then times MC. MC means maturity or duration of anticipated cash asset or liability. So the duration of my bond portfolio. So sorry, the particular bond. Then divided by F. F is the face value of the futures contract which I am going to hedge, and maturity of futures contract or the duration of futures contract, times B. B is the expected rate movement on cash instrument divided by expected rate movement on futures instrument. So B is a factor. What is the expected change in interest rates on the cash market, and what is the expected rate of movement in the futures contract? So let's say we expect interest rate in the cash market to move up by 1%, and if we expect the futures market rates to go up by 2%, the B would be how much? 0.5. If we expect cash instrument rate to go up by 2% and future rates to go up by 5%, the B would be 2% divided by, so 5%, basically 2 over 5. So then when you plug in those numbers to this formula, you can find out how many futures contract of the particular future you need to buy or sell to hedge your position. Okay. Then determine the appropriate time frame for the hedge. Okay, so then you determine the time frame for the hedge depending on what you are going to hedge and monitor the hedge performance. Of course, that's what I told, monitoring is important. You don't have to wait till expiration from a hedge. There may be a point of time you can benefit from the hedge, even though, you know, this is not expected for the speculation, but if there is a beneficial, you know, price, you know, increase, interest rate increase, okay, sometime you can exit at that time because you can make a profit out of the deal and still cover up your position. So you do not have to wait till maturity or the expiration date. So you can monitor the hedge performance, and if you feel there is a good opportunity in the market, to exit the market so that you can reverse the futures trade. I said there are three options available when you are holding a future, either buy or sell. You can reverse the future. You can wait till expiration, or you can you know, close the transaction through the delivery. Okay. So let's move on to the macro hedging. So we focus micro hedging. Micro hedging is basically focusing a particular instrument, asset, liability, or commitment. The macro hedging, as I mentioned, focuses on reducing interest rate risk associated bank's entire portfolio rather than individual transactions. So we don't look at individual assets or liabilities in the balance sheet. So we look at the entire balance sheet or portfolio of particular balance sheet assets or liabilities. Now, in the hedging, I think we already did gap analysis, the interest rate sensitivity. So we can use gap or earnings sensitivity hedging. Oh, all of you know we discussed gap. You know, gap could be either positive or negative. Okay. If the gap is positive, I think we mentioned earlier, so the bank is asset sensitive. So if the interest rate rise, assets, you know, impact on rising interest on asset is higher than the liability. Okay. So that means net interest income rises if the interest rate rise. When the interest rate falls and the bank asset sensitive means its net interest income rises when interest rate rises, and interest rate falls, the net interest income also falls. Remember, when we discuss the rate sensitive gap, the gap equal RSA minus RSL times change in interest rate. So the gap positive means if the interest rate rises, net interest income rises. If interest rate falls, net interest income falls. So if there is a positive gap, we can use a long hedge. So your balance sheet particular position under the gap sensitivity is positive, you can use a long hedge. you can buy futures. If the gap is negative, you can short futures or you can sell futures. Okay. So because in a long gap, long position, or the positive gap, what is the risk to you? The interest rate decline. So when you in the interest rate decline means price go up. So you better buy futures now. In an interest rate, if you are a negative gap, what is the risk to you? Interest rate rise. The interest rate rise, what does it mean? Price will interest rate rise, price will drop. So you become short futures. So positive gap, you go for long futures. A negative gap, you go for short futures. So you can look at the entire balance sheet, assets and liabilities. You can find out the gap or earning sensitivity, and depending on the gap position, you can either do a long hedge or short hedge. Positive gap. Use a long hedge. If rates rise, I already explained, the bank's higher net interest income will be offset by losses in futures position. If interest rate falls, the bank's lower net interest income will be offset by gains on the futures position because you have a long futures. So negative gap, if it's a negative gap, use a short hedge. So what do you mean by a short hedge? Negative gap means what is the risk to us? Interest rate rise or fall? What is the risk? If you have a negative gap in the balance sheet, interest rate rise or fall, when is the risk? When is the risk? We already did this some time back. Gap analysis. When you have a negative gap, when is the risk? Interest rate rise. So when the interest rate rise, you lose your income, interest income. But now you are shorting futures. What happened? You make a gain in the futures position. If the interest rate falls, you are not at a risk. So you have a higher net interest income, but you will incur loss in the futures position because the interest rate falls, future price will rise. You have short hedge. So it doesn't matter whether your interest rate rise or fall, because of the hedge, you are minimizing your risk position. So your loss will be minimum. Okay. To eliminate the risk in a macro hedging, so bank could structure the portfolio so that its duration gap equals 0. Remember duration gap? DA minus KDL. Remember? Change in equity equal minus duration gap times A times delta R divided by 1 plus R. So this is the typical formula we use for duration hedging without convexity. I think with the convexity it's little different. Remember, you can remember the formulas. So the change in equity, the value of equity equal minus duration gap times delta Y divided by 1 plus Y times market value of assets. Remember, this is what we did. So futures can be used to adjust the bank's duration gap. Now, what we are trying to do is we can use futures contract to minimize the interest rate risk. So how do you do it? We can plug in certain numbers to this formula, okay, and find out the appropriate futures contract to hedge in that portfolio or the entire balance sheet. So duration of assets times market value of rate sensitive assets divided by 1 plus interest rate on assets minus duration of liabilities times market value of interest rate sensitive liabilities divided 1 plus I plus duration of financial futures multiple times multiplied by market value of futures divided by 1 plus interest rate of futures should be equal to 0. So that since we know DA, DL, all other numbers, we can find out the rest of the DF and market value of futures contract, so that we can find out how many contracts we need to hedge the position. Okay, plug in the numbers. For example, if you have a duration of assets 2.88, liabilities 1.61 with market value, so we can find out market value of financial futures to hedge the position completely, and then find out a particular instrument to either buy or sell to cover up our risk position. So it's pretty straightforward. If you know your numbers in the balance sheet, you can do a macro hedging so that you can identify a particular financial futures contract, and you can decide whether you should sell or buy depending on the position. If the interest rates are going to go up, what happens? You will sell futures, and if the interest rates are going to come down, you will buy futures so that you can cover up your position. Okay. The bank has a positive duration gap of 1.4 years. Therefore, the market value of equity will be declining if interest rate rise. The bank needs to sell interest rate futures contracts in order to hedge the risk position. The short futures indicates that the bank will make a profit if futures rates increase. Okay. So if you have a positive duration gap, better you sell futures contracts. Okay. Now, for example, let's say you are, you have in your balance sheet. In your balance sheet, there is a possible risk as per the structure. If the interest rate increased by 1%, your balance sheet value will be lost by $12,000. Okay, let's say 12,000 rupees market value. So how do you hedge your position? If the interest rate rise by 1%, you have a positive duration gap, and you will lose your value by market value by 12,000 rupees. So what you can do is you can identify 4 futures contracts, because if you hold 4 futures contract, 1% increase means 100 basis point increase. For each 1 basis point, your change will be $25. For $25, if you sell 4 contracts, your gain would be $10,000. So basically, you can partially cover your position by selling 4 euro-dollar futures contract worth $1 million, so that your loss of $12,000 will be partially set off by gain of 10,000. Sale of futures contract, so that your loss will be minimized up to a $2,000 level. Okay, so this is the way the banks minimize their balance sheet position. So you can select, depending on your structure, you can either do micro hedging targeting individual asset or liabilities, or macro hedging targeting entire balance sheet. So basically, macro hedging with futures, pretty simple, way of doing. I explained already. In the on-balance sheet, our change in equity. This is what we discussed during the previous session. Duration hedging minus DA minus KDL times A divided by times delta R divided by 1 plus R. So to offset that, you can hedge using futures. Delta if equal minus DF times NF into PF, that is the value of the futures contracts, into delta R over 1 plus R. So that exact immunization means If you can fully hedge, delta E should be delta F. This may not be possible. So what we try to do is we will look at the delta E, what is the loss. We will try to look at the delta F so that loss can be minimized. So that is called the macro hedging using interest rate futures contract. Any questions so far before we move on to the next session? Anything you need to clear? Anything? Do you have any further questions on hedging? Because we closed the futures now, so we are moving to the forwards. So you have to be thorough with futures, how we are going to use futures, under what circumstances, what is the type of hedge you are going to use, long, short, and okay, if you are given a question on how many contracts you needed, you can use the formulas to identify how many contracts you need, depending on the movement in exchange, interest rate. Okay, good. If you don't have any questions, we'll move on to the forward contracts. I think already we mentioned the futures and forwards are basically the instrument is, the concept is same. The contracts where two parties agree to exchange a specified amount of a designated product at a specified price or a rate on a specified future date. So where the two agree at a particular price at a particular date in the future, execution in the future, but this is not a standardized contract. This is not exchange in the standardized exchange. So what is this? This is a tailor-made product. Remember, you want to buy a shirt, you go to a deal, this is standardized, you may not match your requirements exactly. But forward contract, you find another party who is willing to take the opposite position to match your requirement. Okay, so that is called a forward contract. But what is the problem with the forward contract? What is the problem? What is the problem in the forward contract? It is tailor-made. It's good because you can match your requirement exactly. But what is the problem? What is the problem? The problem is default risk. Remember, because it is a tailor-made contract. The contract may be defaulted by either party. But in a future contract, it is through the exchange, there is no default risk. So the risk is the default risk. Now we look at an example. Now an investment company holds a 6-year bond with 8% coupon, 8% yield, and face value of 1,000, amounting to rupees 500,000. The company intends to sell this entire bonds in 3 months' time in order to settle a maturing debenture issued by the company with a similar value. As the monetary policy announcement of the central bank, policy rates are expected to increase from current level of 6% to 8% in 3 months' time in order to curb rising inflation. Describe the risk in this instance and how you are going to manage it using forward contracts. Okay. So given the scenario, what is the risk and how you are going to manage using forward contracts? So first tell me what is the risk in this scenario, given the company's intention or the objectives. So what is the risk? So what is the risk in this scenario? Because without identifying the risk, you can't decide what you have to do.
Interest rate goes up in time to come.
Okay, interest rate goes up, then what would be the situation? Why interest rate goes up? Why interest rate goes up? What is the reason?
Due to the expected increase in the inflation.
Okay, okay. So so because the policy rate is going to be adjusted right with the rising inflation, so you expect interest rate go up. Okay, with that, what is going to happen if the interest rate goes up? Can you explain further?
The price will lose.
Yeah. So now your objective is you have a 8% yield, 8% coupon bond. The current value is rupees 500,000. So you want to sell it in 3 months' time. So if the interest rate goes up from the current levels, what happened? Your value of the bond portfolio will come down below 500,000. So you can't realize the entire amount. The risk to you is, given the policy rate increase based on the inflation expectations, your market interest rate will go up. If the interest rate goes up, then what happens? Your value will come down from current interest rates are 8%. Okay, the market rates are 8%, 8% coupon, 8% yield. So that is the risk to you. So what you can do is you can, okay, the risk is now you have identified the risk, rising interest rate above the current interest rate of 8%. Then what you have to do to manage the interest rate risk? Using forward contract. So what you are supposed to do? So what are you supposed to do? What you are supposed to do? So what you are supposed to do? Now you came up with a part of the answer. So what you have to do? Now this is your job as a risk manager. Now you have identified the risk is rising interest rate. The price will drop. Now how you are going to manage it using forward contract? What you have to do? Let's think about a perfect match. Let's say think about a perfect match. Because the forward contracts, because this is not futures contract, no. So what you are supposed to do? What you are supposed to do? Now these are the ways you have to act as risk managers. Now you know the scenario, you know the risk. Now you have to manage it. Tell me what you are going to do.
Issue similar rate of similar amount of debentures as at the expected interest rate.
No, but we are not going to use debentures, because now we are going to use forward contract. Describe the risk in this instance and how you are going to manage it using forward contracts. Now, how you are going to use forward contracts to manage your risk position. Read the question carefully. What do you have to do? Anyone? Anyone else? So if you understood the principle, what do you have to do? You have to sell forward contracts. So probably, since it's forward contracts, if you can identify a partner to sell forward contracts at 8% yield today, what happened? You can make a fully hedge. Let's look at it. Now, price of the bond today is 1,000 because your interest rate and the coupon is same. The price of the bond is 1,000. Let's say the interest rate rise from 8%, because the current interest rates are 8%, rise from 8% to 10%. So if you can use the price formula which we did in the previous sessions, your price of the bond in 3 months time is 912. So if now let's say you have 1,000 rupee face value bonds, in 3 months time the interest rate rise to 10%, that will drop to 912.89. So you will incur a loss in the cash market, 87 rupees, 87.11 rupees. So without having a forward hedge, you simply hold the bonds. In 3 months time, when you sell, even though the current market price is 1,000, you can sell only at 912. So you lose 87. But now we are hedging, we are risk managers. So what we do is, today we sold 3 months forward contract at 1,000 at the current yield of 8%. So if you can find a forward contract, now I am talking about a little bit hypothetical case of, forward contract, we can use exactly matching, but you may not be able to find out exact matching, but somewhat closer, because the other party may not be willing to have a similar, bond. So you sell 3 months forward to another party at the same interest rate like today at 8%. So your face value is 1,000. So let's say the interest rate goes up to 10%. Then what happens? The futures contract price will also drop to 912.89. So you are making a gain of 87.11 in the futures, sorry, not futures, forward market. Your forward price will be 912.89, but you sold the forward at 1,000. So you will make a profit. So the cash market loss is offset by forward market gain. So now here is a hypothetical example of a full hedge. So basically you are not worried about the interest rate at all. So basically through a forward contract, you are certain you are going to get to 1,000 rupees today, in 3 months time. Whether market interest rate goes up, down, you will get 1,000 rupees. You are not worried about the interest rate after the hedging. What happens if the interest rate drops by chance? By chance, let's say, even though you forecasted interest rate rise, what happens if the interest rate drops?
We'll make profit.
What happens? You will
Make profit.
You will make a profit. Forward market, you will incur a loss. So those two again offset, and you will get to 1,000 rupees back. So basically through the forward, what you are trying to do is, you make sure, so you are not worried about the interest rate going to take place in the market. It could go up, it could go down. Now you know in 3 months time, I will get my 1,000 rupees after selling of this bond. So that is the advantage you have through this. Because of the profit in one market will offset the loss in the other market. Clear? That is the beauty of forward contract, because forward contract the advantage is you can find a partner. If you want to buy, you can find a seller. If you want to sell, you can find a buyer to meet your requirements to a very great extent, so that your loss will be very minimum. So you are covered. Now in a futures contract, you reduce the loss, but not as per the way you want, because those are standardized contracts. Any questions? Yeah, have you fully hedged? Yes. Loss on the spot position 87, gain on the forward position 87. So you offset your break even, and you recover your entire 1,000 rupees. Okay. Any questions before we move on to the next area of forward rate agreement? No questions? Okay. So if you don't have any questions, we'll move on to the forward rate agreements. I think this is again a very common instrument used by many banks to mitigate the short-term interest rates. Okay. So this is also similar to the over-the-counter futures contract, like the forwards or single period swaps. Okay. Now, so what is a forward rate agreement? When we are going to use forward rate agreements, so one party contracts with another party for a fixed rate that applies to a future period. The buyer receives a payment if the market interest rate exceeds the contract rate, but must pay the seller if the market rates fall below the contract rate. This is again a typical short-term interest rate risk management, technique or the instrument used by the bankers. Very common among bankers. For example, hedging a 6 months period that will commence in 3 months from a contract date is called a 3 against 9 FRA. FRA means forward rate agreement. In 3 months, the payment is determined by comparing the contract rate to the current market rates. So unlike cash deposit where interest is paid on maturity, FRAs are discounted by the settlement rate and the differential is paid on the value date. So basically, forward rate agreement is a very short-term instrument. You look at the numbers, where you agree on a price, the interest rate today applying for a future period. So depending on the FRA, maturity and the FRA period, you can call, M by N FRA. Now, if I tell, what do you mean by 6 by 12 FRA? What do you mean by 6 by 12 FRA? What do you mean by 6 by 12 FRA? Sorry. What do you mean by 6 by 12 FRA? The 6 by 12 FRA is a contract begins in 6 months from today, apply for a further 6 months period. What do you mean by 3 by 12 FRA? What do you mean by 3 by 12 FRA? What do you mean by 3 by 12 FRA? Three by 12 means hedging for a 9 months period commencing from 3 months from today. Okay, so it's pretty simple. The FRAs, how the cash flows change. Now today, we agree a particular rate. Now, for example, I want to borrow 10 million rupees in 3 months' time for a 6 months period. So it's a 3/9 FRA. So what is my risk? I want to borrow $10 million from a bank in 3 months' time for a 6 months period. So what is the risk to me? What is the risk to me?
Interest rate goes down.
Huh?
Interest rate goes down. Possibility to
Interest rate goes down. Sure. If I am going to borrow in 3 months' time, if the interest rate go down, I am very happy.
Yes, yeah, goes up.
Huh?
Goes up.
Goes up. Yeah, I am very much happy if the interest rate goes down, so I can borrow at a lower rate.
Yes.
So the risk to me is 3 months' time when I want to borrow 10 million rupees, market interest rate go up from the prevailing rate today. So what I can do? I can go to a bank or another party to buy a FRA, which is called 3/9 FRA, because I want to borrow for 6 months period from 3 months from today. So I go to a bank, enter into a bank. Let's say I am bank A. So I can go and find out a bank B who is willing to take my question. So I am the buyer of the FRA. Okay. So let's say today interest rate, I agree from the bank B for a FRA rate of 10%. So bank say, okay, we will enter into a FRA. I will offer you interest rate of 10% under the FRA. Now, let's say we are here today, let's say January 3rd, let's say 3 months time, April 3rd, where the FRA begins. So at that time, the market interest rate for 6 months borrowings gone up to 12%. Then what happens? Then what happens? Now, April 2nd, 3 months from today, where the FRA contract begins, the interest rate gone up to 12%. Now, I entered the FRA today at 10%. So, I, Bank A, entered into a, I am the buyer of a FRA, the Bank B, seller of the FRA, to FRA rate is 10%. But now say we come to the April 2nd and the FRA, no, not the FRA, the market interest rates are 12%. So what happens under the forward rate agreement? What happens? Anyone? What happens? Hope you all are bankers. What happens? What could happen? Or what should happen? What should happen?
Bank A should be able to borrow at the rate of 10%.
Okay, so practical sense, what should happen? Then the market rate is 12%. Then how it happens? The market rate is 12%. Will anyone lend me at 10%?
No.
How it happens? Because I already entered to the FRA agreement with Bank B. So I have locked in my interest rate at 10%. So what the Bank B does, Bank B will pay me the additional 2%. Because I am not borrowing from Bank B. I am maybe borrowing from somebody else, but I had the forward rate agreement with Bank B. So Bank B pays me the additional 2%. So What is my interest cost finally? Effective interest cost?
10%.
10%. Whether interest rate going to 15%, am I worried? No, because whatever the differential is going to borne by the seller of the forward rate agreement, bank B. Now let's say this way. Now I enter into forward rate agreement at 10%, same thing. But let's say market interest rate dropped to 9% by April 2. So April 2, we see the market interest rate drop to 9%. Then what happens?
Borrower has to make that deficit, I mean the 1% back to the bank B.
And borrower? Why the borrower? Borrower means who?
In the bank A.
Yeah, it's not the, yeah, bank A. Bank A has to give the decline, that is 1% to the bank B, the seller of the FRA. So basically then what is my cost?
That is 10.
Still 10. So in a forward rate agreement, like a forward rate contract, I am trying to fix the interest rate today. So whether interest rate goes up in the market or comes down in the market, I know I am going to pay only this 10%. So that is the beauty of a forward rate agreement. So if the interest rate goes up, seller will give me the additional amount. If the interest rate goes down, I have to give the seller, buyer have to give the seller the differential. Okay. And the cash flows are discounted using the whatever the prevailing rate at the time of value or the settlement date. Pretty simple example. Bank A has a commitment that requires borrowing rupees 10 billion from cash market in 2 months' time for a period of 3 months. So what sort of a FRA I should enter into? What sort of a FRA? 2 by 5, because I need money from 2 months' time for a three months period. So I must find a partner or the seller who can enter into a 2 by 5 FRA. So bank A decides to hedge the risk of an interest rate rise by buying a 3 months FRA. So it asks the broker for a price in a 2 by FRA. The broker quotes, now you go to a broker and broker say, I am quoting you 8.5% and the ask price, bid price is 8.45. So bank A offers at 8.5% and deals with counterparty bank B. Okay, so through a broker I find a counterparty bank B. The value date is 2 months from spot date. First fixing is 2 business days prior to the value date. Maturity will be 3 months from the value date. So these are some technical jargon how the FRA, final calculation works. Don't worry about it. So principally, now I entered into, I am a buyer of a FRA, 2 by 5 FRA with from the bank B. The bank B agreed to quote a rate of 8.5% for me. Okay, so I am the buyer. So let's say if the interest rate rises to 9% in 2 months' time, what is the settlement value to the bank A? So basically, the interest rate gone up beyond the FRA rate. So the FRA settlement is calculated using this formula. The notion now here, when we talk about FRA, we only settle the difference based on a notional principle. Now, notional principle is the amount I am going to borrow from the party. Let's say I'm going to borrow 10 million, notional principle is 10 million, times the reference rate. The reference rate is the market rate at that time, minus FRA rate, times days, number of days. Now, if it's a 90-day loan, 90 days divided by the basis. What do you mean by basis? Day convention, number of days per year, 360, 364, 365, whatever the basis you follow. Divided by 1 plus reference rate times days divided by basis. So when you plug in the numbers, you can calculate the FRA settlement. If the interest rate rise, the bank B settles this amount to bank A. If interest rate drops, bank A settles this amount to bank B. So the notional is the notional amount of the loan. The reference rate is either whatever the interest rate, the LIBOR, SLIBOR, Euribor, whatever. And day count convention is generally US 360, Europe 365, and UK 365, or sometimes 364. So can you work out this example before we discuss? Nero Company's cash flow forecast shows that it will have to borrow $2 million from Goodfellows banks in 4 months' time for a period of 3 months. The company fears that by the time the loan is taken out, interest rates will have risen. The current rate is 5%, and this is offered by Helpy Bank on the required FRA. Okay. So what kind of FRA is needed? What are the cash flows if the interest rate has risen to 6.5 when the loan is taken out? What are the cash flows if the interest rate has fallen to 4% when the loan is taken out? Can you try for a few minutes to answer these questions? Any answers? So what kind of FRA is needed?
Four by 7.
4 by 7 FRA, because you want to borrow in 4 months' time for a 3-month period, 4 by 7 FRA. So what are the cash flows if the interest rate rise to 6.5%? Okay. So the interest on loan paid by Nero Company to Goodfellows Bank, $2 million into 6.5% for 3 months. So you have to pay 32,500. Okay, 32,500 if the interest rate rises to 6.5. But now you have a FRA. So what is the FRA rate? 5%. So the bank will, Nero company under FRA by Help Bank will pay the, Nero company 2 million into FRA difference is 6.5 minus 5 divided by 100 into 3 by 12, 7,500. So net cost to the loan to the Nero company is 25,000. So what does it mean? Let's say the current interest rate is 5%. So even though interest rate rise to 6%, I am only paying at the rate of current
5%.
5%. Okay, that is the basic principle, because the other party will bear my cost. Okay, the FRA rate is 5% here. Yeah, the current interest rate and is 5%. This is offered by the LP bank. So let's look at the other example. The rates fall down to 4%. So if the rates fall down to 4%, my interest cost will reduce because I am paying only 4%. Now earlier it was I had to pay 32,500 now, but my cost will reduce. But I have a FRA. Now when the interest rate reduce, I have to settle FRA balance to the LP bank. So the FRA difference is 4 minus 5 because that is the agreed rate into 3 months into 2 million. So 5,000. So I have to pay the LP bank. Earlier LP bank gave me 7,500. Now I have to pay 5,000. So my net cost is how much? How much? 25,000. So whether interest rate went up or came down, I have locked in my interest rate at 25,000. So basically, I agree at 5% today under the FRA agreement. So now I am not worried about the market interest rate. I know whether market interest rate goes up or down. I am only paying 5% for this loan under the FRA agreement. Okay. So let's look at a more technical advanced question. A 4 by 10 US dollar 20 million FRA is transacted with an FRA rate of 3.4%. So the FRA rate is 3.4%. The 4-month forward period starts on the spot date and extend to the settlement date. Typically, the spot date spot date is 2 business days after the rate date. 2 business days before the settlement date is the fixing date. So this is the date on which the value of the reference rate is determined. For this FRA, the reference rate is 6 months US dollar LIBOR. So the reference rate is 6 months US dollar LIBOR. So suppose 6 months LIBOR is 3.7 on the fixing date. The US dollar money market uses the 360-day basis. The basis is 360 days. On the settlement date, the borrower, the party that is long on the FRA, receives from the lender, the party that is short on the FRA, the amount. Because the FRA rate is 3.4, that is the buyer agreed to from the seller to borrow at 3.4, and if the actual LIBOR is 3.7 on the fixed the date, after 2 months, the fixing date, okay, sorry, after 4 months, then how much you will receive. Remember, we use the formula cross settlement. $4 by 10 US dollar 20 million. FRA is 20 million, the notional principal. The reference rate is 3.7. The FRA rate is 3.4. That means 0.037% means, okay. Then number of days divided by 360 divided by 1 plus 1 plus reference rate times days divided by basis. So if there are 186 days during this loan period, so the payment would be US dollar 30,418. Okay, so under this FRA agreement, the seller or the selling bank would settle US dollar 30,418 if the interest rate goes up to 3.7% to the buyer. Okay. Any questions? Any questions? Are there any questions? Oh, clear. Okay, good. Okay, now, so we have covered three types of instruments: the futures contract, interest rate futures, interest rate forwards, the forward rate agreements. Okay, so now we will move on to the interest rate swaps. I think this again typical interest rate derivative used by market participants. So what is an interest rate swap? Okay, a contractual OTC agreement between two parties to exchange a stream of cash flows at periodic intervals based on an agreed upon notional value. Okay, so it is a contractual OTC agreement between two parties. OTC means over the counter, to exchange a stream of cash flows. So basically you exchange a stream of cash flows at periodic intervals. So periodic intervals based on agreed upon notional value. Based on an agreed upon notional value. Okay. So basically here again, like the forward rate agreement, you don't exchange the notional value, but you exchange cash flows based on the interest rate differential. Okay. So let's look at plain vanilla interest rate swap. Give me a minute. Give me a minute. Okay, plain vanilla interest rate swap. In a plain vanilla interest rate swap, one counterparty agrees to pay a sequence of fixed rate interest payments and to receive a sequence of floating interest rate payment. So it's a swap between two parties. One party, pays what do you call it, fixed rate against a floating rate from the other party. So one party pays fixed rate, other party pays floating rate. Okay, so the party who want to receive fixed rate will give a floating rate to the other party, and other party who want to receive floating rate will receive floating rate from the other party. So they basically exchange depending on the scenario. So pay fixed and receive fixed parties. Now there are different categories of swaps. The counterparty who pay fixed rate of interest is said to have the pay fixed side of the deal. The counterparty who receive fixed rate of the interest is said to have the receive fixed side of the deal. Okay. The counterparty who receive fixed rate of interest is said to have the receive fixed side of the deal. Okay. The tenor of a swap is the time over which the periodic interest payments are made. Okay. So basically, tenor is where you agree to pay the interest rate over, let's say, if it's a 5-year swap, if you pay interest rates, 6 months, so the swap periods are every 6 months over the 5-year period. So there are 10 swap, payments. So what is notional principal? Now, I mentioned that in an interest rate swap, you don't exchange your cash flows. Probably you would have done in your exchange rate risk management what is called a currency swap. Have you covered currency swaps during your exchange rate, foreign exchange rate risk management? Have you covered for currency swaps? I think you should have covered currency swaps. So what is currency swap? In a currency swap, you exchange the cash flow also. Now in an interest rate swap, you don't exchange the cash flow, only the interest rate differential. But to calculate the interest rate differential, what do? Calculate the interest rate differential. You want to identify a principal, notional principal. So notional principal is a nominal quantity used as a scale factor to determine the size of interest payment in the swap agreement. So in order to identify the cash flows, let's say the interest rate, you are going to charge under the swap agreement is with respect to a loan of 10 million. So the two swap parties decide the exchange, of interest rate based on the loan amount. So that is called the notional principal. So assume that, for example, a swap covers a 5-year period and involves annual payments on $1 million notional principal amount. Let us assume that party A is the pay fixed party and they agrees to pay a fixed rate of 9% to the party B. In return, party B receives the fixed counterparty, agrees to pay the floating rate of LIBOR to the party A. Okay. So under the swap, party A pay the fixed rate of 9% to the party B, and party B receives the fixed counterparty, and party B pays floating rate of LIBOR to the party A. So depending on the LIBOR rate at the time of payment, the two parties exchange the differential. Okay, two parties exchange the differential based on the notional principal. Based on the notional, we will look at some examples next day. So today I will basically cover the theory part. Now take example how this swap will take place. Now, two financial institutions, one in the US and one in Europe, used to illustrate swap concepts. Now, under what circumstances two parties enter into a swap? Okay, so why a particular financial institution or business institution enter into a swap? Now, in the recent past, the government also sometimes enter into swaps. Okay, remember recently they talked about a swap agreement with the Reserve Bank of India. You see. So similarly, that is a currency swap rather than interest rate. That's a currency swap. But let's take example: a US financial institution with liabilities more rate sensitive than assets is affected by rising interest rate. Okay, so if a particular US financial institutions have more liabilities, rate sensitive liabilities than assets, what happens? If the interest rate rises, they will be at a disadvantage. A European financial institution has access to long-term fixed rate funds but make floating rate loans and has the opposite exposure as compared to the US institution. Now take example of European financial institution. They have access to the fixed rate funds, but they are making floating rate loans. Floating rate loans, okay? So they have opposite exposure. Okay, so they have more rate sensitive assets than the liabilities, isn't it? So for the European financial institution, what is the risk? What is the risk? For the European financial institution, what is the risk? What is the risk?
Decrease in lending rates.
Decreasing interest rates. Okay. So if the interest rate decrease, what happens? Because it has fixed rate, what you call deposits, long-term funding, but floating rate loans. If the interest rate declines, your income from loans will decline, but you have to pay a fixed interest rate of whatever percentage to your funders. So that's the opposite. For the European financial institution, decreasing interest rate because it has more rate sensitive assets. But for the US financial institution, the risk is interest rate rise because it has more rate sensitive liabilities than assets. So it's the opposite. So how they can enter into a swap? Now the benefit is if the two parties get together and agree on a swap, they can minimize the interest rate risk. The one party's interest rate risk is the rising rate, other party's interest rate risk is the decreasing interest rate. Now, how a swap can be structured? So these two parties get together. Now, US financial institutions, US depositors, US borrowers, European financial institutions, European depositors, European borrowers. So US financial institutions, short-term deposits from the depositors, but pay interest on deposits. US borrowers, fixed rate on loans. Borrowers pay fixed rate payment on loans. Okay. So they are the borrowers pay fixed interest rate, but the depositors pay rather, variable interest rate. So rate sensitive liabilities are more. Then what they can do is because European financial institutions receive floating interest rate from loans. Okay. And they pay fixed rate for the deposits. So what they can do is European financial institution can give the floating interest rate payment to the US financial institution. And US financial institution can pay fixed rate payment to the European financial institution, so that they can use it to settle their fixed rate long-term loans. Sorry, fixed rate term deposits. So what happens now, whether the interest rate goes up or down, am I worried? No, because now I have more rate sensitive liabilities in the US as a US financial institution, but I am getting floating interest rate payment, so I am not worried. For the European financial institution, I have more rate sensitive assets, but now I am not worried. I am getting fixed rate payments to pay my borrowers instead of floating rate. So even if the floating rate decline, I am not worried because I am getting a fixed rate payment from US financial institution. So you will see, because of this interest rate swap, both US financial institution and the European financial institution can hedge their interest rate risk. So now both parties are not worried about whether interest rate goes up or down. Okay. For the US institution, what was the risk earlier? Interest rate rise. Now I am not worried because I am getting floating rate payments. For the European institution, what was the risk? Interest rate decline. Now I am not worried because I am getting fixed rate payment to pay my fixed rate loans. Okay. Sorry, to pay my fixed rate depositors. Correct? So through an interest rate swap, you can typically manage your interest rate risk. So if the interest rate increase and the US and foreign institution negotiate a swap, the US institution get higher interest payment as rates rise to help offset the increased cost of funds. If the interest rate decline, then the foreign institution makes lower interest rate payments to the US, which helps offset the lower interest payment the European institution receives on loans. So the both institutions limit the potential benefits they might receive if rates moved in their favor ahead. So US bank foregoes potential benefits from rate declines. The European bank foregoes any potential benefits from rate increase. The different kinds of swaps are possible, which vary in the degree to which they cover the interest exposure and allow institutions to capture benefits if interest rates move in their favor. Okay. Any questions before we stop for the day? Any further clarifications? So we will discuss some examples next class. Then we will move on to the options. So we have some more to cover in this area. Any further questions? So this is the fourth type of derivative we use to mitigate interest rate risk. First we discussed the futures contracts, then we looked at the forwards, then we looked at the forward rate agreements. Now we are looking at the interest rate swaps. Swaps are very common in the markets. Even if your banks, you know, many swaps you find. The currency swaps are also very popular, but since I am focusing on interest rate, I will only focus on interest rate swap. You would have covered currency swaps in your previous module of foreign exchange management. Any questions before we stop for the day?
As in the FRS, the cost involvement is that is locked. No, under the FRA, the cost is locked, right? But under this swaps, that will be changing, or what will happen?
What do you mean by changing? I can't.
I mean the cost. I mean this is the floating and the changing in the fixed rate or the floating rates. No, yeah. So terms of the the cost for one party will be locked or that will be changed?
That depends on the, because now generally the FRAs are short term. Okay. So FRAs are short term interest rate, but now SOPs are more medium to long term. Okay. So if you look at, that depends on the interest rate and the quantum of, borrowing, so we can't say exactly whether it's high or low, because anyway, if you take about 2 years of, if the payments are 6 months, depending on the, if it is a floating rate and fixed rate, depending on how the floating rate fluctuate, one party benefits and one party lose. So that depends on the market interest rate. So we can't say whether which one is better than the other one. But FRAs are generally short term. The SOPs you can extend up to medium term. But in Sri Lanka, SOPs are not very, because SOP you have to generally 1 to 2 years, I think. But in many countries, SOPs can be more, medium term.
Okay, thank you.
Any other questions?
Like in futures, is it possible for an organization to overhedge or underhedge when it comes to swaps?
No, SOPs depend on the, your, requirements. Because SOPs are generally over the counter, OTC. So you can find out a party. Generally, SOPs are, there is no like exchange,
Okay, so you can match the exact requirement, is it?
Yeah, so you can find if there is a party now. That's why generally the SOP brokers are there. So generally how it happens in the market, like that there are money market dealers. Okay, so you can go through a SOP market borrower. Okay, sorry, broker. So the broker will find a party. It's like Babul Kapua, so he will find parties because he will find a party and he will make quotes. That all depends on the development on the stock market and the liquidity, because what this is, if you look at international, this is one of the biggest markets. Stock market appears to be the very large market, so many buyers and sellers. But even in Sri Lanka, it appears to be quite sizable, but depends on the market development. Any other questions before we stop for the day? Please go through the handouts, because so you should know the principles of interest rate. Now all these derivatives we talked in terms of interest rate risk management, but these same instrument can be used for other risk management also. But here I focused only on the interest rate. So that's why I go to discuss about interest rate futures, interest rate forwards, forward rate agreements, and the interest rate swaps. Okay. Because our focus here is the derivatives for interest rate risk management. But there are foreign exchange swaps, like currency swaps, to manage foreign exchange risk. Any other questions? Okay, so if you don't have questions, we'll stop for the day. And please revise the sessions, what we discussed. If you have any more questions, we can start with the questions next day for a few minutes and then proceed to the rest of the session. And we will continue with other parts during next, maybe we have to go, take about 4 to 5, maybe even more than that, depending on how we go. Sessions we will cover after this session, we will look at the what you call the market risk, other components, asset and liability management, liquidity management, and how you can use value at risk models. Then we will look at Basel principles about where the capital adequacy in terms of risk management and governance structures. So we may need to take about another 4 to 5 more, maybe 6 sessions. Okay, so we'll stop here and we will start next day with if you have any questions, and then we will move on to the rest of the session. Thank you.
Thank you, sir.